You're listening to The Intellectual Investor, episode number 85. Good companies don't always make good stocks. Written by Vitaliy and read by Elliot. To read this article online, or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Good companies don't always make good stocks. I was recently going through a new client's portfolio and found it full of the likes of Coca-Cola, Kimberly-Clark, and Campbell Soup, what I call pseudo-bond substitutes. Each one is a stable and mature company. Your mother-in-law would be proud if you worked for any of them. They have had a fabulous past. They've grown revenues and earnings for decades. They were in their glory days when most baby boomers were coming of age. But the days of growth are in the rearview mirror for these companies. Their markets are mature, and the market share of competitors is high. They can innovate all day long, but consumers will not be drinking more fuzzy liquids, wearing more diapers, or eating more canned soup. If you were to look at these companies' financial statements, you'd be seriously underimpressed. They paint a stereotypical picture of corporate old age. Their revenues haven't grown in years, and in many cases have declined. Some of them were able to squeeze slightly higher earnings from stagnating revenue through cost cutting, but that strategy has its limits. You can only squeeze so much water out of rocks, unless someone like 3G Capital takes the company, sells its fleet of corporate jets, and starts mercilessly slashing expenses like the private equity firm did at Budweiser and Heinz. These businesses will be around 10 years from now, but their profitability probably won't be very different from its current level. Not much higher, but probably not much lower either. However, if you study the stock charts of these companies, you won't see any signs of arthritis. Not at all. You'll have the impression that you are looking at veritable spring chickens, as these stocks have gone vertical over the past few years. So this is what investors see: old roosters pretending to be spring chickens. Let's zoom in on Coke. Unlike the US government, Coca-Cola doesn't have a license to print money, nor does it have nuclear weapons. But it is a strong global brand, so investors are unconcerned about Coke's financial viability and thus lend money to the company as though it were the US government. Coke pays a very small premium to treasury bonds. Investors ignore what they pay for Coke. They only focus on a singular, shiny object: its dividend yield, which at 3% looks like Gulliver and Lilliput, that is fixed income land. And as investors do so, they are ignoring an inconvenient truth. They are paying a very pretty penny for this dividend. Coke is trading at 23 times earnings. This is not the first, nor will it be the last time that this has happened to Coke stock. Investors who bought Coke in 1998 were down 50% on their purchase 10 years later, and have not broken even for more than 15 years. And this brings us to the problem with shiny objects. They don't shine forever. Investors are paying 23 times earnings for a very mature business. Consumption of Coca-Cola's iconic carbonated beverage is on the decline in health-conscious developed markets, and you can clearly see this in its income statement. Sales and earnings have languished over the past decade. Let's say Coke does what it has not done over the previous decade and grows earnings 3% a year, despite the shift in consumer preference away from sugar-powered and chemically engineered diet drinks. If at the end of its journey its price-to-earnings ratio settles to its more or less rightful place of 13 to 15 times, then jubilant Coke investors will have lost a few percentage points a year on Coke's price decline. Thus, the bulk of the dividend will have been wiped out by Coke's PE erosion. Coca-Cola, to some degree, epitomizes the US stock market. If over the next 10 years, despite all the headwinds it faces, Coke is able to grow earnings at a faster pace than 3% and interest rates remain at current levels, so that the company's PE stays at the present "I want this 3% dividend at any cost" level, then its stock will provide a decent return. However, there is a lot of wishful thinking in this paragraph. If interest rates rise and/or consumers' tastes continue to shift from high-margin sugary drinks to low-margin commodity water, then Coke will be hit from both sides. Its earnings will stall, and investors will take its eyes off its shiny dividend. Suddenly, they will see Coke for what it is: a 124-year-old arthritic American icon whose growth days are sadly behind it. I am using Coke just to demonstrate the importance of differentiating between a good company, which Coke is, and a good stock, which it is not, and the danger of having an exclusive focus on a shiny object, like dividends, when you are analyzing stocks. And one more thing. I am not a journalist or reporter. I am an investor who thinks through writing. This and other investment articles are just my thinking at the point they were written. However, investment research is not static. It is fluid. New information comes our way and we continue to do research, which may lead us to tweak and modify assumptions, and thus change our minds. We are long-term investors, and often hold stocks for years, but as luck may or may not have it, by the time you read this article, we may have already sold the stock. I may or may not write about this company ever again. Think of this and other articles as learning and thinking frameworks, but they are not investment recommendations. The bottom line is this: if this article piques your interest in the company I mentioned, great. This should be the beginning, not the end, of your research. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.